Are you considering buying a home, but you're worried about your employment gaps affecting your loan approval? Fortunately, you're not alone. And before you get overly concerned, let me walk you through everything you need to know about how employment gaps impact your loan application and, more importantly, how to overcome any potential challenges. Let's dive in. First, why do lenders care about employment gaps? It's all about stability. Lenders want to ensure you have a steady income to make your monthly mortgage payments. A gap in employment could raise questions about your ability to keep a consistent income stream, which is key when qualifying for a loan. If your gap is less than 6 months, no need to panic. Lenders won't necessarily see this as a major red flag, especially if you had a solid work history before the gap, as well as documentation showing you're transitioning to a new job in the same field, ideally, with an offer letter and first pay stub from your new employer. For gaps longer than 6 months, the lender may take a closer look, and you'll likely need 6 months back on the job for gaps over 6 months. Lenders may make an exception if you can supply supporting documentation to show an acceptable reason for the gap, such as caring for a child or maybe a sick family member. Here's some good news. If your gap was over 2 years ago, it's usually not a concern. Lenders focus on your recent work history. So as long as you've been employed consistently in the past 2 years, you should be fine. But what about if you go self-employed after a gap? In these cases, you'll typically need to show at least 2 years of consistent income for your business to qualify. This proves to lenders that your income is stable. You might be able to reduce the requirement to just 1 year of tax returns if your previous job prior to your employment gap was in the same field and involved similar responsibilities as your current business. If you're returning to a job with variable income, like commissions or bonuses, lenders will want to see 2 years of steady income history to calculate an average. The key is consistency. Now, different loan types have different requirements. FHA loans are typically more flexible when it comes to employment gaps. VA and USDA loans may have stricter guidelines and typically want to see a letter of explanation for gaps longer than 30 to 60 days. The best approach? Speak to a lender early in the process so you can have a solid understanding of what's possible for your situation. Then get fully pre-approved before you start seriously looking for a home. This way, you won't face any surprises after making an offer. Once more, employment gaps don't always keep you from achieving your homeownership goals. With the right preparation and guidance, you can navigate the process smoothly. For more information about employment gaps and how they may impact your loan approval, check out mortgageresearch.com. And until next time, happy house hunting.